Hi, and welcome to Midas Investing. Today we're going to be taking a look at ticker SMCI, SuperMicro Computer, which is a manufacturer of high-performance server hardware, including storage solutions, as well as open architecture, fully modular network racks, as well as IT solutions and management softwares for these architecture systems. They're a very interesting player within the computer hardware space in that they have very strong growing relationships with large American software and technology companies, despite the fact that they still command a relatively small market share of the overall global space. Despite the fact that server hardware can be often a pretty commoditized industry, this provides a decent opportunity for them to grow within an already growing space. And there are a few details about them that can belay some of those commoditized concerns, though they also have some risks along with that as well. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. Hopping right into the presentation from their second quarter earnings, they have this chart here showing their history back to 1993, showing how they have transformed themselves from primarily a component and subsystems company into a mostly focus on server racks and server integrated systems, as well as storage systems for the last couple of decades. And then within the last decade or so, they've been trying to diversify a little bit more away from these more commoditized hardware industries and offering a more complete software package along with their hardware, transforming and providing IT services alongside that, giving them a pathway to even more explosive growth into the future. And they talk about in particular right here how they've been growing 5 times faster than their industry over the past 12 months. If you come actually up to this chart they have the scale on the slide before that, they show this acceleration in the growth path versus their industry over the last few years. You can see they were growing pretty much in line with their industry, a little bit slower than the industry at some points within here when they're still heavily focused on the subsystems and memory storage systems as well. And then as they shifted their focus in total IT solutions over the last 2 to 3 years, alongside the global chip shortage that we went through, they've really managed to accelerate their overall growth within the last year, as they were talking about. And being able to provide these IT solutions alongside their hardware is very, very important for them to become a more major player than they already are, especially alongside major competitors of theirs like Dell and HP, which offer more complete integrated systems to much more larger enterprise players, which means that the customer base that SMCI typically relies on is a lot of smaller players that don't necessarily have great IT solutions. In fact, a lot of them are relying on third-party vendors that the vendors that supplied them with these hardwares to begin with. The few exceptions to this being some of the larger software and technology companies that they built good relationships alongside within the United States, and we'll see how those relationships start to grow in the future. Now, one of the reasons I'm really interested in SMCI again, because I did cover them actually last year with a more simplistic valuation, but over the last several months, I've been hearing more and more about them, and it was reigniting my interest in them, is actually related to a really large level of CapEx that they've done over the last year or so. Now, this slide that I pulled up in right here is actually not on the same earnings presentation we were just looking at. This is actually from a couple quarters ago, the Q4 earnings report from the fiscal end of 2022. And it talks about their campus expansion and how their worldwide capacity is now up to 2,000 racks per month because of the fact that they opened up their second US campus, and they're also working on their third global campus. Now, the reason why I pulled back to a couple quarters ago for this earnings presentation is so that I could then show the same thing in the follow-up, which you can see in the follow-up quarter, they had already expanded beyond the guided levels that they had shown in the quarter previously. Now worldwide capacity up to 3,000 racks per month. Again, this is still a quarter previously, talking about the expansion of their US 23 building, as well as expansion within their Taiwan facilities, and then also talking about initiating facilities in Mexico and Malaysia. So then coming back to the actual more recent earning presentation, you can see the same slide has once again shown further expansion, so that they've been essentially being very, very conservative in their estimates of just how fast they were going to be able to pull up this new levels of production. Now, new levels of production, there's kind of two ways to think about this. Obviously, this gives them a huge opportunistic edge against their competitors whenever we go through a situation where there is really, really high demand and low capacity, like the chip shortage that we just went through. Now, whether or not we're going to be able to go through a period where they can take advantage of it quite the same way as the chip shortage we just went through, probably not anytime soon. But the point is by having this capacity available to them, they've now opened up the door to much larger share gains in the future. Now, getting into some of the risks that are associated with SuperMicro, you'll see here on this chart, they show in the most recent quarter their geographic mix of the revenue. And one thing I want to point out is the 18% associated with Asia, which on the face of it is not necessarily too particularly risky. Lots of companies have revenues in Asia. There's nothing particularly wrong with that. But I do also want to point out that this is a relatively larger amount of assets relative to the revenue. 18% of the revenue coming from Asia, but you can see that approximately like 35% of the overall assets are in Asia disproportionately, which again is not necessarily something particularly to be overly a problem with until you get into some of the relationships that exist within the corporate structure with the CEO as well as some of the other companies that they're related to. In particular, SMCI has very, very close relationships with two companies in Asian markets known as Abelcom as well as CompuWare. Now, Abelcom and CompuWare, as it says here, represent 8.2 and 7.8% of their cost of sales for SMCI for the years 2022 and 2021, as well as they make up relatively large percentages of their overall purchases as well. So there's a dual relationship of buying and selling between these two companies back and forth, which again, on the face of it, is nothing super problematic until you take into account the corporate relationships of the executives of this business. Steve Lang, the Abelcom CEO and largest shareholder, is the brother of Charles Lang, which is the president, CEO, and chairman of the board of executives of SMCI. Now we'll have some more to say about Mr. Lang, Charles Lang, because he's a very interesting CEO, and I'm actually kind of relatively impressed with his record at SMCI, but we do have to take into account these relationships that he has right here. As I just said, they have a strong relationship with Abelcom, who the CEO of which is the brother of Charles Lang, the CEO of SMCI. Now, Charles Lang owns no shares of SMCI's stock in particular. However, Charles Lang and his spouse, Sarah Liu, the co-founder, senior vice president, and director of Abelcom, owns about 10% of the Abelcom capital stock, while Steve Lang and other family members own about 28 to 29% of Abelcom's outstanding stock as of the end of the last fiscal year. Now, not only this, but then there's another brother, Bill Lang, the brother of both Charles Lang and Steve Lang, who is a member of the board of directors of Abelcom as well. So you can see there's this kind of circular incestuous relationship between these three companies, and that provides a few different benefits as well as some potential negatives for each of these companies. Now, it's worth noting that I do think actually provides a decent opportunity for SMCI to be getting relatively good margins on certain products. So I do think this is actually a beneficial relationship for their overall business, but it does mean that there's possibly some circumstances where they will be incentivized to act against the interests of shareholders. Now, the reason why I actually do think this relationship is beneficial to SMCI is this statement that it says right here. Abelcom and CompuWare's sales to us constitute a substantial majority of Abelcom and CompuWare's net sales. So effectively, that means that if there is members of this relationship that are the lesser partner, it's going to be Abelcom and CompuWare, not SuperMicro Computer. SuperMicro Computer is effectively the larger elephant in this relationship. So while it is still a bit of a concern that both Abelcom and CompuWare are privately held Taiwanese companies, and then obviously any Taiwanese company, that means that there's any concerns you might have in regards to the Taiwanese, American, Chinese relations over the next 5 to 10 years or something like that. So that's one other thing that has to be taken into account as well. But SuperMicro Computer is still based in San Jose, and even if this particular relationship was to fall apart, I don't necessarily think that it would be the end of SuperMicro Computer. It just might be the end of this beneficial relationship that I think is actually contributive to a higher level of overall capital efficiency, what with the beneficial purchases that they can get from Abelcom and CompuWare, which again, being the substantial majority of Abelcom and CompuWare sales, means that they're going to get the lesser end of that deal. Now, the last thing that also needs to be pointed out, which is another red flag to consider, is that in 2018, the CEO of SMCI, Charles Lang, personally borrowed about $13 million from the spouse of Steve Lang, an unsecured loan with a relatively low interest rate that has actually even been dropped in 2020 as well. But the point is this loan is still outstanding, including interest outstanding, still approximately 16 million or so that is outstanding. So you could say that this is also a liability that the CEO has that could cause him to act disproportionately towards the company. Now, I personally am not overly concerned about it, mostly just because of the actual number of the loan. It's only about 16 million, and while it is secured against the stock of SMCI, if you actually take into account the ownership that Steve Lang, the CEO, has of SMCI, as well as his likely future ownership of the company, which we'll get to in a moment, then you'll see why I'm not overly concerned with it. Now, taking a quick look at the executive compensation package that exists for SuperMicro Computer, you might start to see why I'm not concerned about a $16 million unsecured loan that is held against the stock in the CEO's name. And that's because there's actually this very, very generous stock option grant package that exists for the CEO under certain revenue as well as stock price target goals to be achieved. As you can see, there's a large scaling on here from achieving revenue goals anywhere from 4 billion scaled up to 8 billion, as well as stock price goals set from anywhere from $45 per share up to $120 per share. The stock price goals have to be achieved over a certain average amount of days or something like that, as well as the revenue goals, I believe, have to be fixed to a fiscal annual year. If these things can be achieved in sequence with each other, you can see there's 5 targets for each fund, so you have to achieve the revenue goal as well as the stock price goal. Then for each tranche, he gets 1/5 of 1 million of the company shares to be vested, so 200,000 shares for each one of those, and you can just do the math to figure out what amount of money based off of the current share price that he would get, assuming he was to achieve all of these targets, which I personally think he's likely to achieve all of these targets at least within like the next 5 to 10 years, or within the time frame that they expire, because they do have different expiry time frames. The point is the amount of money he owns on that loan is like 10% of the amount of stock options he's about to get, not even taking into account the ownership he currently already has of the company. But either way, I would actually look at this package as a general positive. I know a lot of people aren't a huge fan of their equity being diluted to stock compensation, but I personally do not really hold that perspective, because I like my executives in particular to be really, really well aligned with shareholder interests. So having revenue and stock price goals to have to be achieved and have to be held for certain periods of time for the CEO to be paid the majority of their pay in equity of the company, I think that's actually a pretty great bonus, in my opinion, to the interest of SMCI. And it's definitely one of the reasons why I'm interested in this company overall. But either way, as you can see, he has achieved the 4 billion and 4.8 billion revenue goal, and he had hit the stock price goal of $45 per share. Again, this is worth noting that this is the annual report that came out last summer. So obviously the stock price is probably somewhere between the $95 and $120 per share as we speak, though he hasn't hit the 120 for the amount of days consistently, and I'm not sure if he's even hit the $95 per share for the amount of days required, but he's probably close in terms of that. But like I said, these things do have to be hit in synchronous with each other. Now, taking a look up further in their annual report, they also give a pretty solid list of the companies that they consider to be their main competitors, including global vendors such as Cisco, Dell, Hewlett-Packard Enterprise, and Lenovo, ODMs such as Foxconn, Quanta, and Huawei, and OEMs such as Inspur. Now, I wanted to take a look at SMCI's metrics against some of these competitors, though I didn't use the entire list. I primarily focused on the ones that I thought were the most like kind with the business that SuperMicro Computer does, including some of those larger competitors that do have some side businesses that are a little bit different, such as Dell, as well as HP, and even Lenovo can be a little bit different. But the point is, it's still, for the most part, is the main companies that SMCI is largely in competition with. So focusing here first on the gross margins that I have, using charts from ticker.com, which I'm a big fan of the website. You can see that SMCI's gross margins in general are relatively in the kind of lower range. You can see there's kind of like a bifurcation between companies that have some of the larger gross margins, like HPE, as well as Dell, which, like I said, that's partially because they have other segments that do slightly other things. So those ones aren't necessarily the greatest of apples to apples comparison. But if you're really focusing on some of the lower margin ones, which are more of the ones that are like kind, you can see the SMCI is pretty middle of the pack alongside with Lenovo or with Inspur, which is that lower green one right there. Then keeping with the same companies, but you take a look at EBIT margins, you can see how SMCI's EBIT margin has a little bit more strength to it relative to some of the weaker players within here. You can see that Dell had negative margins for quite a long period of time in here, but they were going through some business transformations during that time. They can account for it. Really what we're trying to see here is just kind of the general range of operating margins that we can get for this type of industry. You can see it's relatively low, between 0 or even into negative territory, up into kind of maybe high single digits, but not even really barely ever hitting double digits, really kind of staying in this kind of like 4 to 5, maybe 6% range. It's a pretty typical kind of operating margins for this type of hardware business. Then turning to asset turnover, which is a gauge of capital efficiency, we get a little bit of bifurcation here as well, which makes a little bit sense when you also take into account the differences between some of the more design focused of these companies and some of the more manufacturing focused of these companies. You can see that SMCI actually has relatively strong asset turnover compared to pretty much all the competitors that we're looking at in focus. I can see that Lenovo has pretty strong asset turnover as well. We can see that HPE has a very consistently weak asset turnover. So you can see that SMCI, very, very strong capital efficiency. And I would actually argue that this is probably where we're getting a lot of that relationship between Ablecom and CompuWare in particular, especially considering the types of purchases that SMCI makes from those companies. That's going to show up more in the capital efficiency more than it does in the actual operating margins. Then if we turn to return on assets, which effectively kind of combines the operating margins as well as the turnover of the assets together to get us a metric that takes the operating and the actual capital efficiency and gauges what is the overall return you're getting against those assets. And what you can see is pretty consistently across this time frame, we can see SMCI has very strong returns on asset compared to their competitors, which again, I think is reflective of the asset turnover, which is reflective of the relationships that they have where they can get relatively cheap capital expenditures, though as we said, that relationship may not last forever. But the point is, I think that that's where we can see that really show up in the numbers, is that they managed to have consistently, except for like maybe a year or two in here, stronger returns on assets compared to their like competitors. Now, taking a look at a couple other metrics, just to get an idea of the kind of structure of their balance on net, we have total liabilities against total assets. So like, okay, what does their balance sheet actually look like? How much liabilities do they have? Is that going to be an extra risk that we have to take into account for the company? And what I will like to point out here yet again is that SMCI, you can see, is actually here at pretty much the bottom of the pack consistently across the entire decade. Very, very nice to see. So like they managed to be very capital efficient while also actually having very, very low amounts of liabilities. That's very, very good. That means that they have a little bit more wiggle room to move and a little bit more flexibility with their ability to change their overall operating structure if necessary. And then one last balance sheet metric I wanted to take a look at was the inventory turnover. Now with the inventory turnover, we actually want this number to be relatively high, which gives us an idea of like how quickly can they move through their inventory. And this is the part where SMCI is actually going to look a little bit weak. You can see that SMCI has pretty much the bottom of the pack inventory turnover across the entire decade. You can see that Inspur has a relatively low inventory turnover, not too dissimilar. And you can also see that Dell had, or not Dell, you can see HPE had higher inventory turnover that is starting to shrink more in line with SMCI, while Dell has pretty consistently higher inventory turnover along with Lenovo. But I would also argue that perhaps since it's so consistent across the decade, that perhaps that's more of a function of the way they've organized their structure and maybe not necessarily a worrisome sign. A worrisome sign would be that we had a relatively higher inventory turnover that then shrank down very, very abruptly, because that would mean that they were suddenly building up those inventories. All right, switching gears here a little bit, I wanted to take a brief look at the pricing in the market for these companies over about a 2 to 3 year period, which is about the length of time that we really have for these metrics that aren't large outliers or negative, making the multiples meaningless. But so for right here, I have the same competitors that we've been looking at, but I do have 2 lines for each one of them. one of them being the enterprise value to the EBIT metric, and the other one being PE ratio, both of which being the last 12 months trailing. So the current PE for each of these metrics, and you can see that it's ebbed and flowed pretty significantly across the either the metric that we're looking at as well as the time frame we're looking at, anywhere from kind of maybe in the 30 range for kind of the peak for some of the more expensive ones at certain points, to possibly even maybe high or not into kind of like mid single digits, possibly around like 5 for some of the low points. So like even just kind of like a midpoint between that range would get you kind of like mid to low teens or something like that, and which kind of seems to be pretty middle of the pack expectations for a multiple for these companies. Now, taking a look at the same companies and the same metrics, the PE ratio and the enterprise value to EBIT metric, but now looking at it on the next 12 months projected forward with analyst estimates, you can see pretty consistent with what we were just seeing, though it's a little bit more compressed. Now you can see most of the multiples kind of fit between 5 and 20, with some deviations up into the upper 20s. But maybe 5 and 20, which gets us still kind of in that kind of like low to mid teens range, much closer to maybe like low teens for more of like a forward multiple expectations for this kind of industry. All right, so to make my projections for the revenues of the company, I'm relying on some research reports as well as some market share reports that I found here on Business Wire, talking about market share within the chip space, both in terms of units and in terms of pricing, as well as the IDC website, which gives a decent amount of market forecasts for this industry, as well as some other market reports that I found on Grand View Research, as well as Fortune Business Insights, which give some estimates by some analysts and some economists about projections for the server industry moving forward. In my spreadsheet, I took pieced together effectively very limited amounts of quarterly information that I could find for these market shares to get estimates of what trailing annual numbers would look like, both in terms of the units and share for the industry. You can see the bars is the global totals of units being sold on, like I said, a trailing annual basis for each of these quarters. So globally, you can see it's in the range of like 12 million units up to maybe like 13 million units. It's kind of like shifting up and down over the quarters between 2019 and 2022, as well as the share of the units being sold by various companies, the same companies that we were looking at, the competitors that we were focusing on, as well as a kind of larger grouping of the ODM direct vendors. You can see SMCI has a very low market share in terms of the total global market share of units being sold off. And if you're taking it in terms of overall revenue, likewise, though the revenue part has tipped up in the more recent quarters and starting to grow. I did take an estimate between the data that I had, getting an idea of the estimated price per unit, but it's worth noting that this isn't entirely apples to apples, because for a lot of the competitors, I was actually able to get specific price per unit information from those market research reports. But for SMCI, I kind of had to back into that number just from the revenues and the segment information they give in their quarterly and annual reports. And so as a result, this number is actually a little bit elevated because it includes some of the IT solutions specifically in there, not just the price for the unit. So you can see like how the SMCI price per unit grows over the last year and a half, but that's not really the price per unit. That's more effectively like the revenue gained per unit. And so you can see kind of the effect of their growing IT solutions across this particular platform. The actual price per the normal unit, they're still relatively in the lower range of the pack, and that's really the space within the market, the segment that they kind of focus on. As I said, some of the larger players like Dell and HP, you can see have some of the higher price per units because they offer larger integrated systems to larger enterprise players. But anyway, so moving past some of this, like I said, these are just past data that I pieced together so I could get an idea of where the market currently stands, so I could make projections for the future. We're not really actually even relying on those graphs so much for the actual projections themselves. Now, based off of the information that was pieced together from the Grand View Research and the IDC reports, as we were saying, the global unit totals being between 12 and 13 million for the last few years, about 13.4 or 13.5 million at the end of 2022. Based off those research reports, we have expectations that that's likely to grow up to maybe around 16, 17 million by 2027, which is basically the years that those research reports go out to. And then outside of that, we also have the global average unit price over the last several years, which has been between $7,000 and $8,000 per unit for the global average, which if you look over the growth rate for the last several years, it's really been approximately in line with inflation, which you might have expected the pricing to maybe grow faster than inflation. But as we kind of like talked about a little bit before, computer hardware in large part is heavily commoditized unless you can offer a really unique integrated solution or software package alongside it. So really that's kind of important to understand, because our projections for future pricing, we're really just going to use our expectations for future inflation, which I'm currently relying on about 2.25% as my future expected inflation. That's the market set expected inflation based off of the TIPS market. So with that, I'm going to project that the global price for the chips by 2027 will get to around $9,000 or so per unit. Overall, as we said, with the global unit levels getting up to 16-17 million. So, and then if I make projections past the 2027 level, based off from Grand View Research, their levels of growth that they're projecting is about 4.6% per year during that time frame. But for the few years prior to that, it was actually growing at about 3% per year. So I'm going to assume that after 2027, it's then going to go back down to maybe about 3% per year, and that's going to get us to maybe 19 to 20 million units or so in 2032, which is the year we're trying to project to. So that's going to be our estimate for the global market in 2032 for both our base and bear cases. I do have a base, bear, and best case solution up here. And then for the best case solution, I'm actually going to assume that the market continues to grow at that more accelerated 4.6%. So maybe under a better case scenario, the market grows at a much more rapid rate, and we end up at 21 million units in 2032 or so. Then the average of SMCI's market share that we saw that they had achieved during the last several years, based off of unit share from the graphs that I had put together, show that they had on average about a 5% market share over the last few years. So in our base case assumption, we're just going to assume that they keep that 5% market share, keep it real simple, which gets them a little bit less than 1 million of those units. Now in our bear case assumption, we'll assume that they actually get about 1/3 less than that, which gets them down to less than 700,000 units, maybe about 2/3 of a million units. And then in our better case assumption, we're not relying on a market share number particularly. We're actually just relying on the fact that, like I said, we're assuming that the market grows at a little bit more of an accelerated rate. And based off of the accelerated rate, we can work backwards into the larger share number right there, which gets us a potential market share of 8.8%. So market share growth for SMCI, that's basically our bear, base, and bull cases, is anywhere from 3.4% market share to 8.8% market share. Base case assumption, maybe about 5% market share. Now, for the unit price growth, now as we had kind of talked about, we are assuming that the market itself could potentially grow faster than inflation, but it's more likely to grow in line with inflation. So for the SMCI's price growth, I'm going to assume it basically just kind of grows in line with that. It's relatively simplistic, but I don't really have anything particularly useful to add to this, so I might as well just rely on a relatively simple base assumption. I'm going to use that same case assumption across each of the bear, base, and bull cases, because I'm already using the market share as my way of gauging the differences for the market performance for SMCI. So with that, I end up with a unit price. Again, this would be more like a revenue per unit price, not an actual sales price, because it's going to technically include some of the integrated and IT solutions and software solutions that are included in here. But 8.6 thousand or so is going to be our price for that. If you multiply that by the units that are being sold, that gets us a bear case revenue assumption of 5.6-5.7 billion or so in 2032, 8.5 billion for our base case assumption, and then 16 billion exactly for our bull case assumption. Now, this is the part that I didn't fully explain. Like I said, I had said that we relied on the market share growth here, but then I also worked backwards into the units that are being sold. The way I did this is based off of the revenue that I'm kind of already assuming they're going to get. And I'm going to say, like, why are you just assuming 16 billion in revenue for the bull case assumption? I'm relying on that 20 billion target that they're attempting to address with the overall scale that they've grown here, and I've just cut it by approximately 20%, which is 4 billion or so. So it's relatively simplistic, but for the bull case assumption, I'm effectively going to assume that they're just going to fill capacity over the next decade. That doesn't even take into account the fact that they could theoretically try to grow more capacity and theoretically try to grow beyond that. but I also think that that's a pretty good simplistic assumption, because there's frankly just so much growth potential in front of it with the relatively low market share that they have and the growing space. But I don't really feel necessarily overly capable of making Super Bowl predictions about who they're going to steal that market share from exactly. So I would much rather rely on growth of the industry and then maybe allow for a best case assumption where they do manage to fill out most of the capacity they already have. My argument being that since they have the capacity, that gives them the competitive advantage against those who don't. So with that, if we come over to my valuation spreadsheet and take a look at the quartiles of the revenue outcomes that I put in here, you can see the bull case outcomes. I have it coming up to about 15.4 billion. So it's a little bit shy of that 16 billion that I put in there. And the base case assumptions I have coming up to 9 billion. So that kind of balances off that. It's a little bit higher than the 8.5 that we had put in there. And then the 6 billion here is a little bit higher than the 5.4 there. So a little bit more bullish than the model I put together for the base and bear cases, and then a little bit pulled back for the bull case. So kind of like tightening it more into the middle, which I think makes a good sense. Taking a look at those on the charts, you can see the cumulative growth cases as I have right here, where in our bull case assumption, we're assuming they grow by perhaps 125%. Base case assumption, maybe it grows actually relatively low levels over the 10-year period. And then the bear case assumption, they actually really just barely manage to hold on to the revenues. Now, I will say, like, I think this is actually a relatively conservative measure, especially considering, like I said, the capacity that they have in order to possibly take share in opportune moments. The problem is that it's just hard to project these opportune moments, and so I'm not really going to do that. Now, in terms of operating margins and how I'm going to project for my operating income, that gets a little bit more complicated, especially given that they're currently going through a little bit of a high level of profitability timeframe, which is likely to erode as they build into those larger scales that they've been adjusting with their capex. That's going to increase the overall levels of depreciation. So as this happens, they're currently having high margins, but they're likely to go through a little bit of a compressed margin time frame in the possibly near term, which then will probably expand back into higher margins again. But then at some point or another, it needs to settle back down into a relatively low kind of single digit margins, as we were kind of showing over like the historic charts I was showing earlier across their industry. You can really get this kind of like 4 to 5 to 6% margin for these types of high infrastructure hardware based companies. And it really comes down to making those share gains that's going to have the largest effect on their value. So with that, you can kind of see the story I just painted in the margin assumptions I have right here. I have them starting relatively high on a range between like 6 to 10%, coming down in the near term down to relatively low single digits, very, very low single digits in the near term, and then bouncing back up to those kind of higher levels that they're currently at before then slowly trailing back down to a range between 6 and 4%, about 5% or so on the overall net. You can see how this plays out into the operating income quartiles for each of the years. And then in the terminal year, the operating income distributions right here, you can see really the weighted average is maybe like 450 to 550 or so, or around 500 million or so in the terminal year for the operating income. And for their capital investment levels, because of, as we've already shown, the high levels of capacity that they've already built over the last year or two, we're really going to have them actually start off incredibly capital efficient up front. And it's really going to move downward towards a more terminal level of capital efficiency in the terminal year. But really, they're going to have basically no levels of reinvestment for the first few years on net. It's basically just going to all be maintenance capex. And then over the longer term, it's going to start to build into more a regular flow of reinvestment. We can see how that plays out into the returns on invested capital, what with the also margin effects that we were just talking about, starting off relatively low, going through a little bit of an ebb and flow before kind of leveling off into kind of this like kind of mid-teen levels. The free cash flow distribution, you can see in the terminal year, the free cash flow distribution starts to get a little bit wider, but with the way in which this capital efficiency affects the previous graph of the operating incomes, you can see most of the outcomes end up between about 150 and 350 million, which is a pretty wide range of free cash flow distribution. You can see that the tail really does stretch out here towards some of the higher levels of free cash flow. Now, what with the high-tech focus of their industry, as well as the geographic disbursement of their revenues, they do have a relatively high cost of capital in the near term, also with a lower debt-to-equity ratio. That means it's mostly equity-focused capital costs. So it's a relatively high cost of capital in the short term, which I'm allowing to moderate over time. And then I am actually allowing them to keep a relatively high terminal growth rate in terms of like the valuations that I make, which gets them a relatively decent terminal multiple. As you can see, kind of like mid-teens, which mid-teens for a forward multiple. And again, we were showing their history for over the last 10 years for their for their market competitors, we saw more of like a low teen forward multiple. So I would argue I'm giving them a pretty decent boost in terms of their actual terminal value. But regardless of that, with the actual capital costs and the assumptions we put in place, I still end up with the quartiles of fair value of anywhere of 50% of the fair values being between $61 and about $95 per share. You can see the distribution of fair values right here. You can see what I mean by that, where about the majority of the outcomes are really in this kind of band right here between maybe like 60 and 100 or so, with some upside well above 100, some decent upside even to the current fair value, but lots of potential downside too, what with the fact probably because of those lower margins in particular in the terminal year. You see how this plays out into the distribution of expected returns as well in this particular chart right here. And on this page, you can see the summary of the expected case assumptions, what with average operating margins over the 10-year period of about 6.6%, ending at about 5.1%. Net reinvestment levels, very, very low in the near term, moving towards decent levels of reinvestment over longer term. Average returns on invested capital for the 10-year period of about 16%. And an average cost of capital for the 10-year period of about 9.3%. We end up with a current fair value of about $79.38 per share, which is at the 87th percentile of the current fair value distribution. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So it looks like SuperMicro Computer is still a decent way from fair value. I've raised its fair value a bit from the last valuation I did, and I'm pretty proud of some of the research that I put together and the model that I put together for projections for the future of the company. I'm definitely going to be keeping my eye on this company. As I said, there's some very, very interesting elements to it that I think gives it a strong competitive advantage, at least in the near and mid-term. Though, like I said, there is plenty of concerns to be had for it in the long term as well. Catch you all in the next valuation. Bye.